Before we jump into what's going on today, which is obviously a lot of interesting things happening in terms of how supply chain is disrupted, before the early this year, what were the trends that you were observing in supply chain finance overall, from the vintage point of view you guys have?
I probably will start a little bit earlier than that. Let's go back a bit further in time. 20 years ago, 80% of the world's trade was financed using documentary letters of credit. And the reason for this is that the customer, say in North America, didn't have a close trusting relationship with a supplier in China. So the Chinese supplier wanted a guarantee to be paid on time and in full. And so a bank would sit between them and provide the letter of credit. Mm-hmm. And that's really how global trade was financed for hundreds of years. Over the last 20 years, two critically important things have happened. The first is the development of accounting systems and ERPs that enable invoices to be managed electronically. Trade has gone digital. Mm-hmm. The second thing that has happened is the rise of the internet. This has enabled suppliers in China to reach out and meet customers around the world, and for buyers to meet suppliers. And so over this time, a trusting relationship, a network has built up. And this therefore has meant that today, only 20% of the world's trade is financed using letters of credit. 80% is managed on what's called open account. The supplier gives the end customer payment terms. Somewhere between 30 and 90 days are normal, but sometimes longer is seen. And companies like Alibaba are a critical part of that evolution as it develops into SMEs. So what has become normal for the large corporates, the customers that I work with, is now becoming more and more prevalent underneath. So this therefore has developed, digital trade, payment terms are evolving, and of course, supply chains are becoming ever more real-time. Just-in-time delivery is becoming more and more the norm. And so the direction of travel is how to manage the balancing needs of your customers, right, who want to have as longer payment terms as possible so they can serve their end client, but also manage working with your suppliers who perhaps still need to be paid as quickly as possible. And so this difference of timing between how long you need to give your customer and how quickly can you pay the supplier has given rise to supply chain finance, a financial tool that bridges the gap. A bank basically takes the difference in timing. And this is a very low cost financial product. And the reason for this is the losses are incredibly low to the banks that offer it. Yeah. But it requires platforms such as ours to sit between the two. And this was something that pre-2008, this wasn't a particularly big market. But when the great financial crisis took place and the credit crisis in the States kicked off, this market boomed. And it is now a mainstream financial tool all across the world, and something that it takes place everywhere.
Yeah. So how do you, it's funny you mentioned that, because we also have recently working on different products that will enable our Chinese sellers or sellers on Alibaba platform at large to also sell on credit to the buyers around the world, and then trying to bring some transparency into those transactions and underwriting capabilities so the buyers can pay against. But you also mentioned 2008 as a crisis point, which it helped fulfill, propel the growth of supply chain finance at large. So we are also in another crisis at the moment, economically. In addition to that, this is not only a financial crisis, there are also physical supply chain disruptions. What are you observing in the market today in the last few months?
So Demica has a privileged view into what is going on because our technology platform links into the accounting systems of 500 large multinationals and gives us a real-time view of their sales. And we operate in nearly all the major sectors: manufacturing, logistics, retail, etc. So what does our platform data tell us? It tells us that the economic crisis we're in is significantly deeper and far worse than 2008 was. And the reason for this is that in 2008, the economic decline was spread over an 18-month period. Things got gradually worse as the banks seized up, and it really was a financial crisis, not a true depression. Whereas what has taken place in the world today is significantly worse. People should think back to 1930, where you've had massive disruption to supply chains, first in China and then in many other parts of the world, and that is going to be far, far harder to come through. And restarting it is going to be really significantly challenging. So if I look at our platform, for example, I can tell you that tier one automotive suppliers, that these are the companies that supply Chrysler or Mercedes or Fiat, those companies, their sales are down 75% in April, right? The logistics companies, their volumes are down 50%. Mm-hmm. It's every sector you look at, with some exceptions, particularly food and electronics. Most sectors are down 50% on average in Europe at the moment. North America, not so bad at the moment, but that's because COVID-19 came a couple of weeks later. Mm-hmm. We're seeing the similar level of impact of disruption in the supply chain. And the thing to think through really is the fact that no company is an island on its own. We're all dependent on our suppliers and on our customers. Mm-hmm. And that's going to be the hardest thing, because restarting it, so China is gradually coming out now, and suppliers and factories are reopening, but they themselves are dependent on raw materials sourced from other places. So as an example, there was an article in the Financial Times earlier this week stating that the amount of wind farms built this year is now expected to be down 50%, because the factories building the turbines in China and also the blades were closed in the first part of the year. They're starting to reopen, but they buy balsa wood from Ecuador to make the turbine blades, and those areas are still closed. So there's going to be really challenging times ahead of us to gradually reopen the supply chain, and it's going to need really close cooperation with every person along the chain to enable this to restart smoothly.
What about if you're a manufacturer in emerging markets, say China, Turkey, elsewhere, how those companies can, take the opportunity of growth on the current environment, what they should do in terms of running and growing their business?
So we think there are a number of things that suppliers in emerging markets should think about as we move into this new world. The first is that they have a significant cost advantage over Western manufacturing. And so this actually should lead to a continued push, an opportunity for your customer base in China. The second thing to think through is there are going to be massive changes to purchasing patterns, right? The end market in North America and Europe is going to be forever changed, right? You've got tens of millions of people that are unemployed. You've got over-indebted governments that have had to put out a lot of money to support their local economy. So it's very likely that economic growth, even when it recovers, is going to be very slow. And the nature of what consumers do with their money is likely to be very different, right? So when I think through what should a manufacturer in China do, the first thing I think is to spend a lot of time understanding how the end customer's market has changed, right? Because the patterns are going to change. Don't assume that what you did before, whether it's the product you made or the price point that you sold your product at, is going to work in the world that we're about to see. There's definitely going to be very, very significant shifts in the way that people do business, the way that people travel, and the types of goods that they purchase. So the first thing is understand the market. The second thing is to get in the mind of your customer. Your customer is a small company in North America. They've had a near-death experience, right? If you're fortunate, your customers have survived. A very large number of companies will not survive this degree of economic shock. Those that do will have very little cash, right? They will have spent it on just paying a little bit of rent, keeping a few staff on, etc. So the biggest problem that manufacturers in China are going to face in terms of driving volume up is their customer is going to be in a very difficult financial position. So those suppliers and manufacturers in China that can help their North American buyer by allowing them to pay later, so that that North American customer can then sell on into the end retail market or its end customer in North America, are going to succeed, right? This is not the time for a supplier in China to be saying, pay me up front, because frankly, a large number of companies in North America will not be able to afford to. So the people that are going to succeed and win are those that are flexible and are supporting their customers in North America. The next thing to think through is batch size, right? When the market reopens in North America, the companies there are going to not know what has changed. So we're going to see much smaller order lots in the market. People are going to be trialing new products, new price points. So you need to support your customer as it effectively does market research for the first time again, right? Many things will not be the same again. So those are the two things that I can think of. Flexible payment terms, allowing your customer to pay later, flexible lot sizes, and potentially looking at lower price point products for a recessionary environment.